Hi, this is Daniel. You're watching Unrivaled Investing. This is a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. Question I often hear is, how do you find a stock that could potentially go up hundreds or even thousands of percent, a potential multi-bagger? The short answer, I'd argue, is to cheat. Look for a company that's gone up 100% fairly recently and ask yourself, does it have legs to continue? Is the valuation reasonable? What's the story? Can you justify this company being up many hundreds of percent longer term? And so Affirm, AFRM, is one such stock, up over 100% from its recent low. IPO'd earlier this year, but then the stock's been on a roller coaster where it dropped from the IPO price. Now it's up over 100% from its recent low. And investors are asking themselves, well, wait a second, is this the start of a bigger run? Or maybe it does potentially go up hundreds or even thousands of percent over time. I personally am very skeptical. I think this rally is probably overdone for the short term. I think the valuation is very rich, and we'll talk about that in just one moment. So as folks, try to consider, should you chase Affirm, which was up something like 30% today, potentially moving higher, or should you avoid it? I'm in the camp of this is something to avoid, particularly at this valuation. I'll talk more about the unrivaled element towards this end of this video. So let's dive right in to understand this business model where, first of all, Affirm stock up like 30% today, hopping from like $90 to $123 off of their most recent earnings result, talking about 70% plus revenue growth. And the stock had been up even more recently, going from, the $50 handle to the 90s following the news that they were partnering with Amazon on a non-exclusive partnership to help split the cost of purchases of more than $50 into simple monthly payments without later hidden fees. For full context of what does Affirm do, for the folks that want sort of a deeper dive, check out my previous video. I'll leave a link to it below. I liked it at the pre-IPO valuation of $10 billion. This is the valuation that private investors were able to get pre-IPO. Now that it's closer to $40 billion, 4x a valuation that I thought had 265% upside. And now that we have a few more quarters of public execution, I think it's appropriate to reassess or say, where are we? Can we justify this $40 billion valuation that it's now at? One should understand as you look at Affirm, it really is early innings in terms of what's their growth story look like. You're seeing huge growth in terms of their merchandise volume that's growing across their platform, huge revenue growth as well, 70% revenue growth. And you can see, the GMV or gross merchandise volume up 178% ex Peloton. Peloton is one of their largest customers, and so it does sort of hold it back. But you can see that is significant processing, amount of business that's going through the buy now, pay later options that they've created. And the number of merchants that are actively signing on saying, hey, this is a win-win. This is worthwhile because we're going to win more customers. It is incredible the amount of growth they've shown here. 412% growth of number of active merchants. I think a lot of this is probably due to their partnership with Shopify growing from, about 6,000 active merchants to 29,000 active merchants year over year, which is quite impressive. And while this data is a little bit stale in terms of what their GMV was for fiscal 2020, for fiscal 2021, it was closer to $8 billion. And, they're targeting a U.S. e-commerce sales, $600 billion, global e-commerce sales, $3.4 trillion. If you're able to get inside the point of sale, if you're able to get physical sales, now you're talking about $5 trillion retail market. So you're talking about just barely a drop in a much, much wider ocean in terms of the potential here for them to grow. This does suggest early innings with long-term growth, potentially high growth for the years ahead. So what are my thoughts on the valuation? Here it is. I'm going to do a quick plug for those interested. My name is Daniel. You're watching Unrivaled Investing. If you enjoy learning about potential multi-baggers, please make a point of hitting that subscribe button. If you're already a subscriber, I do appreciate that thumbs up. If you want to follow my personal journey, go to unrivaledinvesting.com. First week of the month, I call out my full portfolio. By the end of the month, I call out a potential multi-bagger. We also have a dedicated community, an exclusive server, a Discord where I'm interacting with the Unrivaled Nation on a daily basis. So check that out at unrivaledinvesting.com for those interested. And looking to try to figure out the valuation for Affirm, the outlook, they did provide an outlook with their most recent earnings update, talking about GMV of nearly $13 billion this next year, talking about revenue of nearly $1.2 billion in revenue, still expecting significant losses for the year ahead, over $100 million in losses, guiding to 290 million in weighted average shares outstanding. That would be their basic amount. Their true diluted amount is over 300 million shares outstanding. So to understand this guidance, though, that's about 37% revenue growth from their 870 million in revenue. So that's about 70. That's a huge deceleration from their 71% growth. Effectively saying, going from 70 to 40% this next year. And so maybe that's them being conservative. Maybe Wall Street's saying, oh, they're just, sandbagging it because there's a lot of cool stuff going on here. They are still guiding to very, very, very strong GMV growth of 54% guidance for this next year, getting to that $12.3 billion figure. Likely unprofitable for years, as I already mentioned, with this $100 million, expected operating loss this next year. And so that is worthwhile to understand. It is definitely worthwhile, as I love to look for companies that are unrivaled, because when you're unrivaled, it means you're doing something right. You have this opportunity to grow faster than others. If you're unrivaled, that's not the case here, because Afterpay, arguably one of their top competitors, is not only multiples of their size, but is also growing faster. So that is worthwhile to consider. Like, whenever you see a company that's bigger and growing faster, that means they truly have a machine that's running really well. And so I'd argue, yeah, that should mean maybe reflect on a potential discount that you'd want to apply here. Just something to consider. So as I look at the valuation, considering how I want to reflect and, what do I think is the risk reward from here? Currently around $124 a share, 317 million. That's effectively their fully diluted share count. That gets you to around closer to $40 billion market cap. So yeah, they did post 70% plus growth this past year for their fiscal year. They're guiding to, low end 40%. Well, they're guiding to around, high 30s. I'm going to say, yeah, they're sandbagging it. Maybe their growth is between 40 and 60% this year. So I'm being what I would argue is aggressive. I usually like to have management guidance be the mid case, and then, maybe I reach a little bit. So I'm saying management guidance is really conservative, and in reality, they can grow 40 to 60% this next year. Saying some sort of optimized margins, even though they're nowhere near profitability now, saying longer term, maybe they're profitable somewhere to the tune of 15 to 25% profit margins based on their revenue. Either way, you're looking at a company that's trading effectively at 30 times forward sales, not super compelling. Then the question is, well, what's your growth rate in the years ahead? I'm saying like 40 to 50% annualized. This is best of the best type of growth, which they could possibly achieve given the fact that, you're aiming for, 10 billion, around 10 billion plus in GMV, and they're tackling markets that are hundreds of billions of dollars. So, if not trillions of dollars, as I talked about a few slides ago. So I'm looking at this thinking, yeah, it's definitely possible to have 40 to 50% annualized growth. Possible, not saying it's for sure going to happen. This is a framework, keep in mind. I always want to pencil out effectively, what am I playing for? What can I rationally say, hey, this is a reasonable valuation. This is how I think about this. How could I think over the next 5 years? So that way I'm saying I'm playing for something worthwhile. Of course, there's always room for a company to over deliver. There's also room for a company to completely whiff, where I'm like, yeah, I was penciling out 40% and you only delivered 30%. That would be a problem for a firm. So here it is. I'm saying, yeah, you deliver on these profit margins, you deliver on these exceptional growth rates, 40 to 50% annualized over the ensuing next 4 years beyond fiscal 2022, where I'm penciling out 40 to 60% growth, and multiple 5 years out saying 30 to 40 times earnings based on the margins I said above. And honestly, it is just not a compelling risk reward at all. As I look at this, I'm effectively looking at more downside at this price over the next 5 years. I'm not saying 10, 20 years. 10 years, maybe it does better because you have a long, you effectively work through this valuation premium. But over the next 5 years, I'm saying this is a tough risk reward. The upside downside isn't that compelling at this price. I think anyone that says, hey, double down at $124, that's marketing. That's not rationally thinking about what's the valuation. But if you think I'm wrong, I'm missing something, leave a comment below. If you're like, you know what, Daniel, here's the element to this that you're missing. Here's the reason why, let's say, they're going to be closer to 60% growth, and this is the reason why they're going to beat management's guidance. Or you think the multiple 5 years out should really be 50 times versus the 40 times. I think that's a tough argument to make, but if you have it, feel free to leave a comment below. And I'm ultimately looking at a company that's growing, guiding to high 30s%, 40% growth, trading at 30 times sales. Whereas, my most recent potential multi-bagger posting 200 to 300% growth, trading at 4 times sales. So a huge discount. If you're willing to turn over rocks, you find these things. And that's, I call that out for my Unrivaled Investing Journey subscribers. That said, for now, as I'm looking at Affirm, I'm effectively saying this is just too hard for me. I think this goes in the avoid pile at this valuation. I think the value proposition of buy now, pay later could be very solid for customers and merchants. They're not unrivaled, as clearly Afterpay is growing faster than them and they're bigger. And so you have this not unrivaled and it's expensive. Not for my journey at this point. Love to hear your thoughts in the comments below. If this video has been helpful for you, please make a point of hitting that subscribe button, hit that thumbs up. Thanks so much for watching.